Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, there's nothing better than managing your investments on your own. Not relying on someone else to make decisions about your money gives a different level of satisfaction, gives a different level of confidence. But you want to manage it well because there's no point managing it yourself and then depleting the worth of your investments, right? So watch today's episode very carefully because today we are going to give you pointers to help you strategize better. Stay tuned.
The beginning of your personal financial plan is get your asset allocation right. All the savings that you have, divide it among equity, fixed income, or any other assets correctly, and that's the only way you can guard yourself against calamity or financial calamity. And the way to deal with it is, I would like to give you a simple plan how to plan your asset allocation. If you are 10, 15, 20 years away from your retirement, let your money be dominantly into equity and nominally into fixed income. So that is, 3/4 of your money or 2/3 of your money into equity and remaining in fixed income. If you are getting close to your retirement or you have substantial savings and you are in retirement, then maybe divide your money into equity and debt equally, and you will get an opportunity to rebalance it. If your money, once you have divided your money into equity and debt equally, 50% in equity, 50% in debt, then if it changes by 10%, your equity becomes 55%, more than 55%, reduce it to 50% to equity. This way you will be able to buy high, buy low and sell high when in case of equity. And by changing your allocation, rebalancing it, it will work. When you get closer to your retirement and you are on a tight accumulation budget, then you should be substantially into fixed income, nominally into equity, so that you don't lose your sleep if the market goes down. And that way you will have a portfolio which will be able to beat inflation or at least match inflation and yet provide you the stable income. Now, how do you figure this out? What is your asset allocation? Come to Value Research online, set up your investments, put your everything, because this is the only portfolio tracker which can have your equity fund, fixed income, PPF, your NPS, and it will aggregate everything. And as a result of all your investment, it can also have fixed deposits, bonds. So as a result of your different investment at different places, you will, and all you have to do is work for 10 minutes to accumulate to collate all the information about your investments, and it will give you a very precise asset allocation on a day-to-day basis. And this will be of immense help for you to keep track of your asset allocation. So knowing what should be your asset allocation is one thing. Making sense of it, finding what it is, and taking some corrective action is another thing. And Value Research Online helps you do that. Most investors are advised to diversify their investment. It helps you reduce your risk. And the way to diversify is, and many investors have taken it to their heart as well. The way to diversify it is that make sure that your investment is spread over, is geographically diversified. It is diversified across the segments of the market, which is large cap, mid cap. Market is made up of various complexion of stocks and different sectors. So make sure that you're ensuring that your investments are spread across sectors of different sizes, companies of different sizes, as well as different geography. And the case for diversification is very simple. You are able to de-risk yourself from any big disaster that comes in a narrow segment of the market. If all your money is there, you'll be very badly hit. Now, investors, after taking this point, they actually overdo it many a time. If you buy many funds, you are not diversifying. Many a times you end up collecting funds. You become a collector than an investor. And the result of that is that if you own 10 such funds, 10 different mutual funds, You might have a portfolio of something like 300 stocks, and you may not know it. You think that you have 10 funds. You think you are diversified. Likewise, there are investors I have come across who own some stocks and who own some funds, but they are not diversified simply because of a concentration of their investment in a specific thing. So, finding that you are truly diversified and you are not too over diversified. Too much of diversification is also a problem, and unknowingly having a concentrated portfolio is also a problem. So, how do you strike this balance? Uh, Set up your portfolio at Value Research, and it will give you a fact sheet of all your investments, how your money is spread across sectors, how your money is spread across different capitalization of companies within that. And then you can tweak your portfolio to make sure that it is diversified and not too much diversified. We are often told that make sure that your investments are top quality, they're high quality. And mind you, you must have. Why it matters? You remember the key lesson of Gita? Listening to a pravachan, I can tell you that I was told that even there, quality matters. Uh, Kauravas got the army, and Pandavas got Krishna, and that is what made all the difference in Mahabharata. So that is what happens even in investment. When it comes to investment, quality matters. You can have a large number of companies, well diversified, too many companies. It doesn't matter. Few of them will end up propelling the returns of your fund, of all your investment. They will be the primary driver. So quality matters. Not only that, poor quality is quite deceptive when it comes to fixed income. They will always look attractive. Poor quality will get you more return. They will be risky, they will be dangerous, they will be low quality, and in the short run they will give you more return. Likewise in equity, if you don't get deeper into it, something which is speculative, something which is going up, something which is manipulative will always look attractive but will not stand the test of time. So you will have to build your own framework of quality or come to Value Research. Value Research Portfolio Manager marks all your investments as good, average, and poor. So if you have a set of bond funds, debt funds, it will tell you which is worth holding, which is worth buying more if you have to invest, or which is worth selling today because of the poor quality. Likewise for equity fund, it will tell you which are worth selling, which are worth holding, which are worth buying more if you are investing more money. And for stocks, it is even more sharper. We are able to spot poor companies based on some quantitative framework, whereby companies which can go bankrupt are very clearly marked. So set up your portfolio, look for the red flags, and that is a warning sign, and that might save you from misery. Investing is a very positive endeavor. We aspire to actually generate more return for ourselves. We want our investment to perform. And for this, we need to look at performance. We need to look at returns very objectively. And the way to look at returns objectively is to really understand how much you have earned. Uh, the way to look at it is if you are investing in shares, if you are investing in stocks, then you might buy something for 100 rupee and it might become 120 rupee. And during this period, you might would have received some dividend. So you have to factor that dividend as well. There is a possibility that good company which is giving you dividend is also giving you a quarterly dividend. And maybe the market tanks and the stock price goes down. So calculating your return becomes very complex. Value Search Portfolio Tracker takes care of everything. Also, in case of shares, there could be a periodic bonus, there could be a periodic rights, and there could be a split. Your 10 rupee shares actually gets split into 2 rupees shares, and the value of the share gets divided by 5. or your 10 rupee shares get divided into, becomes a face value of 1 rupee, and the value gets divided by 10, by 10, and you're all confused. You bought something for 100 rupee and it has become 50 rupee, and you are thinking that your money has been halved, but it is not, because there is a split that happened, or maybe a bonus that happened. So how do you calculate? So looking at performance objectively is one aspect. This is where value research portfolio trackers is most comprehensive. It takes into account everything that happens in the life of that investment during the period you are holding. So there is nothing like this. I haven't come across any such portfolio tracker. Besides that, there are a lot of value additions. Our tax authorities, they treat our gains, all the capital gains, into very complex ways. You know, the debt. If you invest in a debt fund, your returns are treated as income till you're holding. If you realize any gains before 3 years, if you hold it for 3 years and more, it will be treated as capital gains. Capital gains is indexed. Capital gains is indexed with a different formula for debt, which is 20% with indexation. So it's complex, but we give you all the hard data for you to decide and feel happy or sad with your returns. Because just earning return is one part. Optimizing it for taxation, because tax you can't avoid, so you have to factor that in. Likewise, for equity, the tax is pretty complex. All your return for less than 1 year is added, is treated as short-term capital gains, which is taxed at 15%. And returns of more than 1 year is considered as long-term capital gains and taxed at 10%, but with an exemption of up to 1 lakh rupee or something like that. So take a closer look at everything. So when you maintain your portfolio here, you will be able to get all the information which will empower you to decide which one to sell in a tax efficient manner. It can also give you some tax tips in terms of where we are working on some additional things, but you can use this idea to begin with. Assuming you made two investments, 2 lakh rupee in one equity fund, 2 lakh rupee in another equity fund. One equity fund became 3 lakh rupees and you had 1 lakh rupee gain. You sold it off, you realized that gain. And now this 1 lakh rupee gain is subject to 10% capital gains tax, long-term capital gains tax. The other investment that you made, that 2 lakh rupee got reduced to 1 lakh rupee. It is in losses and you want to hold it. For some reason, it has gone into losses. So in this situation, you will be paying a 10,000 rupee capital gains tax on the first investment that you have realized. If you sell your second investment and buy it again, you have immediately created a 1 lakh rupee loss for yourself. And because this 1 lakh rupee loss will offset the 1 lakh rupee gain on another investment, you are now not subject to you are not liable to pay any taxes. If you have all the information, you can do these planning, and this can help you reduce your tax bill. When investing in mutual fund or investing in shares, a lot of investors start in a hurry and they miss out on some very simple rules for themselves, which they should keep in mind. That will make sure that their future, or the investment which are being made, are put to good use and you will not have future complications. One is that when you are investing, make sure that your brokerage account has the same phone number which you are going to use at all times. Normally nowadays people do have that Aadhaar linked phone number, and use that. Second is, have a single email ID where you can access all your information for confirmations and other things. Make sure that you have the nominee carefully designated in your investment, and get it verified, validated. Don't open your account without nominee. So if you have these 2-3 things, and after that all the standard diligence that buy before, I would not like to get into the financial analysis or all the guidelines which you should keep in mind before buying a share. But I think one simple guideline that always invest in something that you know and why, before you invest. Because if you don't have answer to these two things, that why and where you are investing, don't invest. Don't get carried by the mob herd mentality. A lot of people are saying, a lot of people are investing, so you should too. That doesn't work. It does not benefit. And most of the time, when you have such pressure built around you, it turns out to be counterproductive, and it turns out to be injurious, financially injurious. When it comes to mutual funds, same rules. You should have the nominee, you should have the phone number, and keep it simple. Few equity fund, few debt fund. There are 32 kind of open-end funds possible, or mandated by the regulators to have. But your needs are mostly fulfilled by 2 3 4 5 kind of funds, depending on your investment experience, depending on your dependent time frame. You can choose one or two kind of fund, and that will be good. That will be good enough. Make sure that nominee is there carefully, and now it has become mandatory. Also, all your make sure that your numbers are consistent and they are live, because now it has become mandatory that you invest. When you redeem your mutual fund investment, you will get an opportunity to authenticate your or approve your redemption request, and that will require having your phone number phone handy. So it is a great security, it is a great safety measure, and make sure that you are careful with your phone number. Don't, because earlier it used to be that you put your phone number and sometimes it is active, sometimes it is not, physical forms, and now it has become all the more important. So if you have these 3 4 rules, and then in case of mutual fund, one more rule to follow. Make sure that you are investing only in the growth option, because the first and foremost thing is that growth or dividend. So you're investing in the growth option, that keeps it simple. And when you are in the accumulation phase, the dividend plan doesn't make sense. In case of shares, you don't have a choice. Companies, when they give dividend, you have to take it. It gets credited in your bank account. So, and then I think the other simple thing that you should keep in mind is, do an annual verification of all your investment that you have made, and keep a record of these things at a handy place, and keep your nominee posted about all the investment that you have made. Otherwise, it just might go unused, for which you have been you're making these investments, just in case the need arises.
Well, that's it for today. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.